Today, we're going to uncover the secrets behind those little bars you see on your trading screen, candlestick charts. You've probably noticed them during your trading sessions, or even when casually checking stock prices. But what do these candlesticks really tell us? They look like tiny candles with wicks, but there's actually a whole story hidden in each one. And today, I'm going to break it down for you in the simplest terms possible. So here's the deal. Every time you see those bar charts showing up on your screen, whether for stocks or cryptocurrencies, they're painting a picture of what happened in that specific trading session. The candle part is actually a visual representation, like the wick of a real candle. And the wick shows us how much price movement there was during that period. And here's the surprising part. These candles can tell you more about market sentiment than you might think. Let's take a look at one in detail to understand what it means. Imagine each candle like a day in the life of a stock or cryptocurrency. The body of the candle shows us the opening and closing price for that trading session, while the wicks indicate the highest and lowest prices reached. Now, let's say we have a green candle, which is also known as a bullish candle because it means the closing price was higher than the opening price. It's like saying the stock had a good day today. You can almost picture the market being happy at the end of that session, driving prices up. And if we see a red or black candle, which is called a bearish one because it means the closing price was lower than the opening price, think of it as the market feeling not so great. It's like saying the stock had a tough day today. This could be due to various factors, news, economic reports, or even investor sentiments. But that's just the tip of the iceberg. These candles can also reveal trends over time when you look at them in sequence. For instance, if you see a series of green candles with long bodies and short wicks, it might indicate an uptrend where buyers are stronger than sellers. Conversely, if you notice more red candles or those with longer wicks, that could mean the market is volatile, with prices swinging widely. So there you have it. The little bars aren't just pretty graphics. They're giving us valuable insights into what's happening in the markets right now. But remember, while candlesticks can be useful for understanding past price movements and trends, they shouldn't be used alone to make decisions. They're better when combined with other tools and analysis. So, you're curious about candlesticks, huh? But let's be honest, those little lines and bars can look pretty confusing at first glance. Let's break it down with something relatable. Imagine a tiny candle. Think of this candle as a snapshot of a trading day. The body of the candle represents the main action of that day. Now, picture two wicks coming out from the top and bottom of the candlestick. These wicks are like little flags showing you where the day's price action reached its highest and lowest points. And here's the surprising part. If the market opens higher than it closes, we draw a solid green or white candle. Think of it as a happy candle. But if the market closes lower than it opened, we get a red or black candle, a sad one, you might say. Let's use an everyday example to make this clearer. Imagine you're playing a game where you have to guess how high or low something will go in a day. If your guess is right and the price goes higher by midday, but then falls back down by the end of the day, we see a red candle with a long bottom wick. On the flip side, if the price starts low but ends up soaring at the close, you get a green candle with a long top wick. And if it stays pretty steady all day, that's like a short candle without much detail on either end. And here's where it gets interesting. The color of the candlestick, red or black, means the price closed lower than it opened. Green? The opposite, price closed higher. Think of it as a traffic light. Red for caution, green for go. Imagine you're driving on a road that has stoplights. If you see a red light, you know to slow down or stop because something's happening that might not be good for the flow of traffic. In candlestick charts, a red or black candle means the price went down during that period, like hitting a red light. Conversely, if you see a green light, it's like the market is moving in your favor. Things are going up and getting better. A green candle indicates the closing price was higher than the opening price. It's as if the market is saying, go, and you're good to keep driving forward or even speed up. Now, let's look at a real example. Suppose we have two candles, one red and one green. The red candle means that during that time frame, the price went down from where it started. It's like if you were driving and had to slow down due to traffic. On the other hand, the green candle shows that the price increased, like when you see a green light and can keep going smoothly. The color of these candles is crucial because it gives us a quick visual summary of what happened in the market during that specific time period. It's not just about the final number. It's about the journey, the flow of the traffic, or as we say, the ebb and flow of buying and selling pressure. So next time you look at a candlestick chart, pay close attention to those colors. They hold valuable information about what's happening in the market right then and there. And remember, it's not just about the final destination, but also the journey that gets us there. But there's more to these charts. The shadows, wicks, show the highest and lowest prices during the day. And volume bars next to each candle, those tell us how much stuff was traded, like a flood gauge showing water levels. Let's zoom in on one of those candles. Remember, it's divided into three parts: the body, the upper shadow, and the lower shadow. The body shows you the opening and closing prices for that period. But what about all those lines sticking out? Those are the shadows. Imagine a day at an amusement park. The entrance gate opens in the morning, and by nightfall, everyone is left. The height of the queues represents the price movements. If there's a long queue going into the evening, it means buyers were more eager to enter later, pushing up the prices. That's the upper shadow. And what about the lower shadow? Think of it as the reverse, the tail end of the day when people start leaving. A longer lower shadow suggests that prices dropped towards the end of the trading session, despite the initial high interest. Now, let's talk about volume bars. Just like how a flood gauge shows us how full a river is, these volume bars give us a sense of liquidity or excitement in the market during each period. When you see a big fat bar next to a candle, it means a lot of trading activity happened. Think of it as a surge of water filling up the river quickly. So why does this matter? Well, high volume days often indicate that important decisions might be made by those who control large amounts of money. If you notice these spikes and drops in volume, it can give you clues about when big players are entering or exiting the market. So you got the volume and shadows down, right? But why do traders go wild over those little lines and boxes that make up the candlestick chart? Because these bars tell us more than just what happened during a trading session. They reveal patterns and trends, like seeing ripples in a pond can predict where a storm might hit next. Let's break it down. Imagine you're standing by a river. The water level is usually steady, right? But now, picture a time when the water starts to move, first gently, then more intensely. That's similar to what candlesticks do for traders. Each bar on a candlestick chart is like a snapshot of that moment in the market. If the opening price was higher than the closing price, it's a bearish candle, typically red or hollow. And if the closing price was higher than the opening price, it's bullish, green, or filled. The body of the candle shows us the range where most of the trading happened. But here's the real magic: the shadows. These are like those ripples in our water analogy. They tell us about the highs and lows that were hit during a session, but not necessarily traded at. If you see very long upper or lower shadows, it means there was significant interest to buy below the opening price or sell above it. Maybe because of some new news or rumor. And here's the surprising part. These little lines and boxes are like a weather forecast for traders. They can predict where the market might head next based on past behavior. For instance, if we see several bearish candles with long upper shadows in quick succession, that could signal to traders that there might be some selling pressure building up. So, while it may seem like just a bunch of random data at first glance, these candlesticks are actually like a treasure map to market trends. They show us not only what happened, but also where the market is likely headed next. Now that we've peered into the heart of those candlesticks and discovered how they show us the ebb and flow of buyers and sellers, let's take it to another level. Here's what insiders know. Candlestick charts are just one tool, but they're incredibly powerful for spotting buying and selling pressure. Once you understand them, the markets become a bit less mysterious. Imagine this. You're at an airport, waiting for your flight. The terminal is bustling with people, some heading in, some out. Now, picture those entering as buyers and leaving as sellers. In a candlestick chart, each bar represents one of these moments. The body of the candle shows how much buying or selling pressure there was, while the wick above and below tells us about the highest and lowest prices during that time. And here's the surprising part. Insider analysts use candlesticks to spot trends and reversals even before they become obvious. They look for patterns like doji, when the opening and closing prices are very close, engulfing patterns, where a small bar is completely engulfed by a larger one, or those ominous hammer formations. These aren't just cute little shapes. Each has a story to tell about who's in control. Buyers pushing up prices, sellers forcing them down. So why do insiders love candlesticks so much? Because they bring clarity. In the chaos of constant price fluctuations and news headlines, a well-drawn candlestick chart can reveal what's really happening beneath the surface. It shows us whether we're seeing a strong upward push or a weak downward pull. And that's crucial for making informed decisions.